The beginning of June 2022 marks the planned start to the Federal Reserve's Quantitative Tightening, or QT, program, a contractionary monetary policy tool intended to help curb hyperinflation in the U.S. by reducing the money supply. Implemented in conjunction with the Federal Reserve's plan to continue raising the federal funds rate by 50 basis point increments, this is a decisively hawkish agenda that will likely have an acute impact of the financial markets. Let's explore further as we issue a warning. QT starting now. QT is the sibling program of quantitative easing, QE, its expansionary counterpart. QE is essentially a large-scale financial asset purchasing program that central banks utilize when their economy needs to be stimulated due to lower consumer spending, a mode of money printing. QE entails a central bank purchasing government bonds, mortgage-backed securities, and other assets to increase the money supply, creating new liquidity to encourage more lending, investing, and spending. QT has been described as the opposite of QE in the sense that it entails a subsequent central bank balance sheet reduction, effectively reducing the money supply and removing excess cash reserves to cool an overheated economy. While the Bank of Japan is widely credited with pioneering QE in the early 2000s, the expansionary strategy was popularized by central banks around the world during the 2008 financial crisis. It saw even wider use in early 2020 onward. It attempts to combat global COVID-era economic catastrophe. However, despite its worldwide popularity, both QE and QT remain in their infancy, and are thus regarded as somewhat experimental programs. The last time the Federal Reserve implemented QT was to reduce the size of its balance sheet back in 2017, after it had built up a then unprecedented $4.5 trillion portfolio. They began letting their securities mature gradually, starting around $10 billion per month, and eventually quintupling that pace over the next few years. These measures, in conjunction with periodic interest rate hikes, correlated with relatively stable growth in the U.S. economy. Several variables have changed this time around. First, the rate hike agenda is far more aggressive than it was 5 years ago. Chairman Powell has made it clear that 50 basis point hikes are on the menu for now, a departure from the more modest 25 BP hikes in the past. The timeline for hikes is more rushed than in 2017 as well. Second, this iteration of QT's pace is quicker, with security maturation caps expected to near $100 billion per month by the end of this year. This seemingly corresponds with the Federal's balance sheet being just under $9 trillion this time, near double that in 2017. Third, the U.S. economy does not seem to be weathering this transition well, with a 1.5 contraction in Q1 GDP and a sharp drop in value for the U.S. stock market, in part due to supply chain issues, ubiquitous hyperinflation, and volatile geopolitical tensions. The truth is, we are effectively in uncharted waters, so it is virtually impossible to know what consequences QT or QE belatedly will ultimately have. However, considering our limited experience with it, one or two outcomes seems most likely. QT will have an apparently mild neutral effect on the U.S. economy, to the point that its shrinking of the money supply is nearly imperceptible for buyers and sellers. Considering its historical correlation with economic growth, there is even a chance it could be seen as a slight bullish fundamental catalyst for the U.S. stock market, a harbinger of the end of hyperinflation risks and woes. Aggressive QT, concomitantly with rapid consecutive 50 BP rate hikes, will contribute to a recipe of recession in the U.S., encouraging investors to shy away from riskier securities in favor of government bonds, USD, and other safe haven assets. Analyst Michael Donahue states, "While this scenario seems most likely to me, today's higher than expected NFP numbers showcase a resilient U.S. economy and may have given the Fed more breathing room to pursue this hawkish agenda without recession looming. We will have to patiently keep tabs on other indicators going forward to monitor this." These research-style videos take our team a tremendous amount of time and effort. As much as we enjoy creating these videos for our viewers, none of it would be possible without the support from our channel members. On the screen, you'll see a list of some recent supporters. If you are a big fan of our work and would like to help us continue making these types of videos, consider clicking the join button below our video. By becoming a member, you'll get access to some behind-the-scenes content, a personal shout-out in one of our upcoming videos, cool badges that you can flash on our live streams, private webinars, and so much more. Most of all, you'd be helping us make all this possible, and you'd have our tremendous thanks. Please consider becoming a member down below, and we hope you have a wonderful rest of your day.